Right now, today, there are 5 bills sitting in your mailbox or your bank account that you are legally allowed to stop paying. And the odds are good that you are still paying every single one of them. Not because you missed something obvious, not because you were careless, but because the people collecting that money have absolutely no reason to tell you that you can stop. My name is Jason Carter, and I have spent the last decade helping retirees keep more of their own money. And I can tell you with complete confidence, the system is not set up to remind you of what you are owed. That job falls to you, or to someone like me. Stay with me for the next 13 minutes because I am going to walk you through all 5 of these bills one by one, plus 3 bonus moves at the end that can be worth even more. And I am going to tell you exactly which ones apply to your situation, whether you are living mostly on Social Security or you've got a pension, savings, and a paid-off home. Here is the one thing I need you to understand before we go any further, because it is the reason most people never fix this. Being legally exempt from a bill and actually not paying that bill are 2 completely different things. The law does not automatically refund you. Nobody mails you a check. You have to know the rule exists, and you have to claim it. That is the entire reason we are here. Let's start with the biggest one, Bill 1. For millions of Americans who are 65 and older, the correct amount of federal income tax they owe going forward is far lower than what they are currently paying. And for a significant number of them, the correct number is zero. Zero. And they are still paying it, or still having it withheld from their checks every single month out of nothing more than habit and a quiet fear that something bad will happen if they stop. Here is what actually changed. There is a brand new law. You may have heard it called the One Big Beautiful Bill, and buried inside it is something called the Senior Bonus Deduction. Starting with the 2025 tax year, the one you file in early 2026, every person who is 65 or older gets an extra deduction of up to $6,000. If you are married and both of you are 65 or older, that number doubles to $12,000. Now here's the part that makes it genuinely powerful. That $6,000 stacks on top of everything you already receive. It sits on top of your regular standard deduction. It sits on top of the extra senior deduction that people over 65 have always been able to claim. You do not have to itemize your taxes to get it. You do not have to give up anything else. It simply adds on. Who does this help? Both groups, and I want to be specific about that. If you are a lower income senior living mostly on Social Security, stacking these deductions very likely pushes your federal income tax all the way to zero. In many cases, you may not even be required to file at all. If you are a comfortable middle-class retiree, you are not left out. This deduction is available in full to single seniors earning up to $75,000 and to married couples earning up to $150,000. It only begins to shrink above those thresholds and does not fully disappear until income crosses $175,000 for singles or $250,000 for married couples. The only people this truly leaves out are the genuinely wealthy. One more thing you need to know because it makes this urgent. This deduction is temporary. As the law stands right now, the senior bonus deduction is available for 2025, 2026, 2027, and 2028. 4 years, unless Congress extends it. That means this is a claim it every single year while it exists situation. If you use tax software, it asks your age and applies it automatically. If someone prepares your return, you make sure they applied it. That is Bill number 1. Do not pay federal income tax that you do not owe. And that naturally leads us to the second bill, because it is really the other half of the same story. A lot of people believe Social Security is always taxed. A lot of others believe it is never taxed. Both of those are wrong, and the difference between them can be hundreds of dollars a year staying in your pocket or quietly leaving it. Here is the actual rule. Whether your Social Security benefits get taxed depends on something called your provisional income, which is basically your other income plus half of your Social Security benefit. There is a lower line and an upper line. If you are single and that number comes in under $25,000, or married and under $32,000, then 0% of your Social Security is taxable. None of it. As your income climbs, more of the benefit can be taxed up to a maximum of 85% for higher income retirees, which means that even at the very top, 15% of your Social Security is always tax-free. Here is the win for each group. If you are a lower income senior, there is a very real chance the correct tax on your Social Security is zero. And the new senior bonus deduction we just covered makes that even more likely. If you are a more comfortable retiree, the deduction can still knock your taxable portion down to a lower tier. But here is the mistake that hits people at every income level. When millions of people first sign up for Social Security, they fill out a form called the W-4V, telling the government to withhold federal tax from every single monthly check, just to be safe, just in case. Then a big refund comes back the following year. Think about what that actually is. You are lending the federal government your money with no interest all year long on tax you may not even owe, or far more than you owe. The fix is straightforward. You look at your real numbers, or you have someone look at them with you, and you file a new W-4V to adjust or stop that withholding, so it matches what you will actually owe. Not a dollar more, not a dollar early as a free gift to the Treasury. That is bill number 2. And here is why the next one makes people genuinely angry when they finally find out about it. Bill 3. Property taxes are the bill where I have seen the most confusion and the most unnecessary overpaying across every income level. And the reason is that seniors at both ends of the income spectrum have been told they do not qualify when, very often, they absolutely do. Here is how it actually works. There are 3 different kinds of senior property tax relief, and between them they cover almost everyone. The first kind is income-based, often called a circuit breaker, and it is aimed squarely at lower and fixed income seniors. If your income is modest, this can knock your property tax down dramatically. In some counties, a low-income senior can have a large portion of their home's assessed value exempted or the tax deferred entirely until the home is sold. The second kind is a flat senior exemption that removes a set chunk of value from your taxable assessment regardless of income. This one reaches into the middle. The third kind is the one that the comfortable retiree always assumes they are too well off for, and this is exactly where people leave real money on the table. It is an age-based freeze. No income test, no means test. You qualify because of your age, period. Here is the clearest example. In Texas, once you turn 65, your school property taxes are frozen at the level you paid the year you hit that birthday. Your home can double in value. Your frozen tax does not move, and there is no income limit on that freeze whatsoever. Texas is far from the only state with a program like this. Look at how those 3 programs together cover both groups. The lower income senior gets the income-based relief that can wipe out most of the bill. The comfortable senior who assumed they were shut out of anything still qualifies for the age-based freeze, saving them hundreds of dollars every single year for the rest of their life in that home. Here is the catch that costs everyone, regardless of income. None of these programs are automatic. Your county does not look up your birthday, see that you turned 65, and apply the discount. You have to file. And almost every one of these programs has a hard annual deadline, often early in the calendar year. Miss it, and you pay the full bill that year and wait 12 months to try again. One phone call fixes this. Call your county assessor or search your county name plus the words senior exemption and property tax freeze and ask 2 questions. What relief do you have for homeowners over 65, and which programs are based on age with no income limit? That one call has been worth hundreds to thousands of dollars a year to people I have worked with at every income level. That is bill number 3. Bill number 4 is actually hiding 2 separate overpayments inside it, and one of them is specifically for the retiree who has built up a solid income. Medicare is where 2 completely separate overpayments live side by side, and most people are not even aware of one of them, let alone both. The first overpayment is for everyone, and it is simple. Medicare Part A, the part that covers hospital stays, is supposed to cost you $0 in monthly premiums if you or your spouse worked and paid into the system for at least 10 years, which is 40 quarters. The vast majority of Americans have done exactly that. Yet some people are paying a Part A premium they never needed to because of confusion around a work record, a spouse's history that was overlooked, or a gap that was miscalculated. That is worth a hard second look, no matter what you earn. The second overpayment is aimed squarely at the retiree with a solid income, and it goes by a name that sounds almost like a person. It is called IRMAA, the Income-Related Monthly Adjustment Amount, and it is a surcharge they add on top of your Part B and Part D premiums once your income crosses certain thresholds. Here is the trap inside the trap. The income they use to calculate your surcharge is not this year's income. It is your tax return from 2 years ago. So here's what happens. You are 64 or 65, still working, earning a strong salary. Then you retire, and your income drops sharply. But 2 years later, Medicare looks back at that old high-income return and hits you with a surcharge based on money you are no longer earning. People just pay it because it shows up as a quiet deduction from their Social Security check, and they assume it must be right. It is not necessarily right, and there is a form to fix it. It is called the SSA 44. When you have had what the government calls a life-changing event, and retirement is specifically on that list, along with the death of a spouse, a divorce, or a significant drop in income, you file that form. You show them your income has changed, and they recalculate your premium based on your real current situation. I have personally seen that single form return thousands of dollars per year to a retiree's pocket. Almost nobody files it because almost nobody knows it exists. Part A being free is the win for everyone. The IRMAA appeal is the win specifically for the higher earner. That is Bill number 4, and it leads directly into the one that might surprise you the most because it is not a government bill at all. Every year, millions of seniors walk into a storefront tax office or a big-name chain and pay somewhere between $200 and $500 to have a fairly straightforward retirement tax return prepared. And a significant number of those people legally qualify to have that exact same return done for free by people that the Internal Revenue Service itself has trained and certified. There is a program built specifically for seniors called TCE, Tax Counseling for the Elderly. It is an IRS program for people 60 and older, and it specializes in exactly the questions retirees deal with: pensions, Social Security income, retirement account withdrawals. The largest provider of TCE is AARP Tax Aid, which runs thousands of sites across the country, and you do not have to be an AARP member to use it. The program focuses on older adults of modest to moderate means, and that phrase matters because it does not mean only the lowest incomes. It covers the broad middle, too. On top of that, the government now has its own free online filing options for retirees who are comfortable doing it themselves. I want to be honest with you here because there is a real line. If your situation is genuinely complicated, a business sale, rental properties, a complex estate, then yes, pay a real professional. It is worth every penny, and I would tell you to do exactly that. But if your return is a couple of Social Security checks, a pension, and maybe a few investment statements, the law has already built you a free and fully qualified option. Your age makes you eligible regardless of whether you are getting by on a fixed income or sitting comfortably. Using the free option is not cheap, it is smart. That is Bill number 5, and it is one of the easiest ones on this entire list to act on before this tax season ends. Now, I promised you 3 bonus moves, and I want to be upfront about who these are for. The 5 bills we just covered reach across every income level. These last 3 are specifically for the retiree who has built up some assets, a home that has appreciated, an investment account, a healthy IRA. If that is not where you are right now, everything you need is already in the first 5. But if you have built up something, these 3 moves can be worth more than everything else combined, and almost nobody talks about them because most videos never get here. Bonus move number 1, the home sale exclusion. Here is the fear that keeps people frozen in place. You bought your house decades ago for $80,000. Today it is worth $400,000, and you are terrified that if you sell it to downsize or move closer to family, the government is going to tax you on that enormous gain. So you stay in a house that is too big, too expensive to maintain because you are afraid of a tax bill that, in most cases, does not exist. There is a rule called the home sale exclusion. If you have lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain if you are single, and up to $500,000 of gain if you are married filing jointly. Gain, meaning what you sold it for minus what you originally paid, minus the improvements you put in over the years. That couple who bought at $80,000 and sold at $400,000 likely has a gain of around $300,000 after improvements. As a married couple, they can exclude $500,000. Their federal tax on that sale is 0. They were sitting in the wrong house for the wrong reasons, afraid of a tax that was never going to touch them. Bonus move number 2, the 0% capital gains bracket. If you have money sitting in a regular brokerage account, stocks or funds that have gone up in value, There is a bracket in the federal tax code that most people outside of financial planning circles have never heard of, the 0% long-term capital gains rate. When your taxable income is low enough, the federal tax on your long-term investment gains is not 15%, not 20%, it is zero. For 2025, a married couple can have taxable income up to roughly $96,700 and still pay nothing on long-term gains. For a single person, that line is around $48,000, and that is taxable income, meaning after your deductions come out. So a couple bringing in well over $100,000 total can still drop into the 0% zone after the standard deduction and the senior bonus deduction, and sell appreciated investments without paying a single dollar of federal tax on the gain. The years right after you retire, before large required withdrawals kick in, are often your lowest income years. That is the window. A smart retiree harvests gains in those years on purpose, completely tax-free, instead of letting everything pile up to be taxed at a higher rate later. Bonus move number 3, the qualified charitable distribution. This last one is for anyone who is 70 and a half or older, gives to charity in any amount, and has money in a traditional IRA. It is called a qualified charitable distribution, a QCD. Once you reach 70 and a half, you can have money sent directly from your IRA to a qualifying charity, up to $108,000 per year, and that money is completely excluded from your taxable income. It never shows up as income in the first place, which is even more powerful than a deduction because it lowers the income number that everything else is calculated from. Your Social Security taxation, your Medicare surcharge, all of it. And once you reach the age where you are required to take required minimum distributions from your IRA, a qualified charitable distribution counts toward that requirement. So instead of being forced to pull money out, pay tax on it, and then donate what is left, you send it straight from the IRA to your church or your cause, satisfy your required withdrawal, and pay zero tax on any of it. If you give to any cause at all and you have an IRA, this is one of the most powerful tools available to you right now. So, let me leave you with the one idea that ties everything together. In every single case we covered today, the senior bonus deduction, the Social Security tax rules, the property tax freeze, the Medicare appeal form, the free tax preparation, the home sale exclusion, the 0% gains bracket, the charitable distribution, the law already says you qualify. It already says you are exempt or you are entitled. But not one of them is automatic. The government does not refund you for a rule you did not claim. No one mails you a check for a deduction you forgot to take. The system is built so the money stays exactly where it is unless you stand up and claim what is yours. Being legally exempt is worthless until you act on it. I put together a free checklist, the Jason Carter Retirement Tax Checklist, that walks through every break, exemption, and money-saving move we covered today. It lists what to claim, what form to use, and what deadline to watch. The link is in the description below. It is completely free, and for almost everyone watching, it is worth far more than it costs you, which is nothing. Before you go, do one thing for me. Send this video to one person over 65 in your life, a parent, a sibling, a neighbor, a friend from church. It does not matter if they are getting by on one Social Security check or sitting on a paid-off home and a solid nest egg. The odds are very good that they are paying at least one of these bills right now for absolutely no reason at all. One share from you could be worth more to them than any gift you will ever give. I will see you in the next one.